The U.S. commercial vehicle market is bracing for impact as a new wave of tariffs threatens to upend the industry. A proposed 25% tariff on imported commercial vehicles slated to take effect soon is sending shockwaves through the sector. This looming levy is poised to affect a significant portion of U.S. commercial vehicle sales, potentially reshaping the landscape of truck manufacturing and trade. The ramifications of this policy shift extend beyond U.S. borders, as Canada and Mexico, key players in the North American auto industry, are expected to retaliate with tariffs of their own. This tit-for-tat escalation could have a chilling effect on near-term truck sales and reshape the intricate web of manufacturing supply chains that span the continent. Classes 4 through 8 trucks, the workhorses of the trucking industry, are particularly vulnerable to these trade tensions. A substantial portion of these vehicles, particularly Class 8 trucks, are imported from Canada and Mexico. The imposition of a 25% tariff on these imports would represent a significant cost increase for U.S. buyers. This price hike is unlikely to be fully absorbed by U.S. commercial vehicle suppliers, who are already operating within tight margins. Consequently, the brunt of these increased costs is likely to be passed on to consumers in the form of higher prices for new trucks. The specter of a tariff-induced price surge is already casting a shadow over the U.S. commercial vehicle market. Industry analysts predict that the proposed tariffs could lead to a substantial increase in new truck prices. This price hike, coupled with the broader economic uncertainty fueled by the tariff dispute, is expected to dampen demand for new trucks. The potential consequences of this decline in demand are far-reaching, potentially impacting truck manufacturers, suppliers, and the broader economy. However, the impact of these tariffs is not uniform across all manufacturers. Original equipment manufacturers, or OEMs with different production footprints, are likely to experience varying degrees of exposure to these trade headwinds. For instance, Ram, which relies entirely on its Mexican production facilities for its trucks, faces a significant challenge. On the other hand, Volvo, with its entire production concentrated in the U.S., is relatively insulated from the direct impact of tariffs on imported trucks. This disparity highlights the complex and nuanced ways in which tariffs can reshape competitive dynamics within an industry. Beyond the immediate impact on truck prices and sales, the tariffs are also rippling through the broader freight and logistics sector. Recent data on freight volumes paints a mixed picture, with some indicators suggesting a softening in demand. The uncertainty surrounding the trade dispute and its potential impact on the economy is likely contributing to this cautious outlook. Businesses, wary of the potential for escalating trade tensions and economic slowdown, may be hesitant to commit to large-scale investments in new trucks and equipment. The capacity situation in the trucking industry is also in flux. While capacity has been tightening in recent times, the pace of contraction appears to be slowing. This suggests that the market may be approaching a point of equilibrium, albeit one characterized by a delicate balance between supply and demand. The influx of private fleets entering the market has played a role in keeping capacity in check. However, the looming threat of tariffs and the potential for a slowdown in freight demand add a layer of complexity to this equation. The trailer market, a key indicator of future freight demand, is also exhibiting signs of uncertainty. While the worst of the recent downturn in trailer orders may be behind us, the industry is entering a period of subdued order activity. Economic concerns, exacerbated by the tariff uncertainty, are prompting fleet decision-makers to exercise caution in their investment decisions. The reluctance to commit to new trailer orders reflects a broader wait-and-see approach as businesses grapple with the potential fallout from the trade dispute. The confluence of these factors, softening freight volumes, shifting capacity dynamics, and a cautious trailer market, points to an industry navigating a period of heightened uncertainty. The outcome of the ongoing tariff negotiations will play a crucial role in shaping the trajectory of the U.S. commercial vehicle market in the months and years to come. Amidst the uncertainty pervading the broader trucking industry, the flatbed sector stands out as a pocket of strength. Flatbed rates have been on an upward trajectory, reaching their highest levels in recent times. This surge in rates is indicative of robust demand for flatbed transportation services, defying the broader trend of softening freight volumes. The factors driving this demand are multifaceted, with some attributing it to increased construction activity and infrastructure spending. However, this strength in the flatbed sector is not necessarily indicative of a broader recovery in the freight market. Other segments, such as reefer and van, tell a different story. Reefer rates, for instance, have been languishing near their lowest point in several years. Similarly, van rates, while showing some signs of life, remain relatively subdued compared to historical levels. This divergence in rate trends across different segments of the trucking industry underscores the uneven nature of the current freight market. Load volume data provides further insights into these trends. While overall load volume has shown some improvement, this increase has been primarily driven by the strength in the flatbed sector. The Market Demand Index, a key indicator of load volume, has reached its highest point in recent months, largely due to the surge in flatbed loads. This suggests that the demand for flatbed transportation services is outpacing other segments of the trucking industry. The reasons behind this surge in flatbed demand are not entirely clear. Some analysts had initially speculated that it was driven by businesses stockpiling steel and other materials in anticipation of the tariffs. However, this theory has not been borne out by the data. Regardless of the underlying causes, the strength in the flatbed sector provides a glimmer of hope in an otherwise uncertain freight market. The U.S. commercial vehicle market stands at a crossroads. The looming threat of tariffs, coupled with softening freight volumes and a cautious outlook for the broader economy, has injected a significant degree of uncertainty into the industry. The outcome of the ongoing trade negotiations will play a pivotal role in shaping the trajectory of the market in the months and years to come. If a resolution to the trade dispute can be reached and the tariffs averted, it would remove a significant headwind for the industry. However, even in the absence of tariffs, the market is likely to face challenges. The cyclical nature of the trucking industry, coupled with the potential for a broader economic slowdown, suggests that the road ahead may not be smooth. The duration of these tariffs remains a key unknown. If they persist for an extended period, it could have far-reaching consequences for the industry. Manufacturers may be forced to adjust their production footprints, potentially shifting some manufacturing away from the U.S. This could have ripple effects throughout the supply chain, impacting jobs and investment. The U.S. commercial vehicle market is at an inflection point. The decisions made by policymakers in the coming months will have a profound impact on the industry's future. Navigating this period of uncertainty will require a delicate balancing act, weighing the potential costs and benefits of different policy choices. The stakes are high, and the outcome will have far-reaching consequences for the U.S. economy.